The Federal Reserve has released an explosive report detailing its failure to take adequate action ahead of the collapse of Silicon Valley Bank last month. This collapse sparked an ongoing banking crisis for mid-sized U.S. banks, and trading in another such bank, First Republic, was briefly halted on Friday when its share price plummeted 48%. The report brings into serious question the Federal Reserve's ability to respond to an industry in crisis. SVBs skyrocketed in size in the lead-up to its collapse. The report from the Fed reveals extreme weaknesses in bank management and regulation, as well as obvious government oversight deficiencies. The report cites that the Federal Reserve did not detect the seriousness of critical deficiencies in governance, liquidity, and interest rate risk management as issues in the firm. The Fed is now taking measures to reevaluate how it manages banks of Silicon Valley Bank size and scale, as the 2018 banking law scaled back some of the increased restrictions put in place after the 2008 financial crisis. Interestingly, the Federal Reserve report also reveals issues with executive compensation at the bank. The paper notes that these bonuses and rewards did not include any risk management, and that, at the time of the collapse, there was no chief risk officer at the firm. The investigation looks into the roles played by the three main bank regulators: the Federal Reserve, the Office of the Comptroller of the Currency, and the Federal Deposit Insurance Corporation, which may have missed warning signs in other similarly sized banks, such as Signature Bank in New York. Finally, the paper factors in the role of social media and technology in the bank's last days, with a bank run of customers withdrawing their deposits, often at the tap of a button on a mobile device, in a matter of hours compared to days for the 2008 crisis. The report and the events following it being released points to an underlying crisis of confidence in the industry, with First Republic Bank in San Francisco seeing a huge loss of deposits, in spite of receiving a $30 billion intervention from major banks. The release of the report and its findings provides a rare insight into how the central bank supervises these banks and proposes